Su-Lin, good to see you. Good morning. Appreciate your time. Hope you're keeping safe where you are. Did the numbers surprise you, or were they pretty much in line with what you were expecting?
Look, we were expecting a pretty strong print for Q4 GDP, a really good bounce back in the fourth quarter. It actually came a bit below our expectations. We thought maybe we would print even higher, but nevertheless, a really strong print. It shows, I think, very clearly the bounce back in activity after the lockdowns in Q3 across New South Wales, Victoria and the ACT. So those three states were really the outperformers in Q4, driving that big recovery in activity, a huge amount of pent-up demand. You can see it in household spending that was up over 6% in the quarter. It really is a story of, what happens when you let people out of lockdown and let them spend and get on with their lives.
I hope you're getting out and spending as well, Su-Lin. It's Will here. In terms of that, I wanted to talk about consumption because we saw it up by 6.3%. You've got the savings rate dropping to around about 13.8. In terms of when you're looking ahead, Q1, Q2, with all of the, I suppose, other inflationary pressure now starting to come through, do you think that that could potentially crimp the consumption story a little bit alongside the pent-up demand surge that we are seeing at the same time?
Yeah, that's, I think, an interesting question. Look, from the data that we've seen for January, February, both the official numbers as well as some of the alternative data, the economy looks to have started the year in better shape than we would have thought, given Omicron disruption that started late last year and for a lot of January. But we've seen a pickup in mobility. We've seen increased credit card transactions from late January. We've seen stronger retail sales for the month, as well as a pretty resilient labour market. So there's no doubt that higher inflationary pressures, particularly fuel, which will hit disposable income, is something to factor in. But the early signs have been good in terms of weathering the Omicron disruption. Higher fuel may temper disposable income and spending a little bit, but we are also mindful that consumers have built up a lot of savings and a big buffer over the last 12 to 18 months, and that can be deployed over the course of this year whenever there is a bit more of a shock, whether it's high fuel prices or whatever else comes our way.